My name is Jessica, and I'm the Accounting Services Manager at Mitzi Sullivan CPA PLLC. And you're joining us today to about the podcast S Corporations Explained, where Nick's going to kind of tell us a little bit about should your business be taxed as an S Corp, what are the benefits and cons, and before we get into that, though, let's check out the links in the description for this video to join us on Facebook, LinkedIn, Twitter, and sign up for our monthly newsletter to make sure you're getting all the updates for the changing tax laws and regulations as they're released, and follow our discussions of business and tax strategies. Please leave a comment to ask questions, and with that, I'm going to turn it over to Nick.
Thanks, Jessica. Today, I'm talking about S corporations, and I'm excited to dive into this topic and hopefully make things a little more clear for the business owners out there and why maybe electing the S Corp tax status would be beneficial for you. So just to real quick kind of explain everything and lay out the foundation, there are generally 4 types of business entities, which would be your LLCs, your corporations, your partnerships, or your sole proprietorships. Those are generally going to be your main business entities. But then on the other side, you have tax entities, or tax the way that the IRS views your business. And so, for example, if you're an LLC and you're a single member LLC, you're taxed the same way as a sole proprietor. You file your tax return with a Schedule C, disregarded entity. If you're the LLC, you do have to file another report, but from a federal income tax perspective, it's going to be the same. Now, if you are an LLC, you've probably heard people say, hey, you should elect S corporation status and you'll save on taxes. What does that mean? So I'm going to dive into that. But one thing I did want to mention is that the S corp status essentially combines parts of both the 1065 partnership tax status and the 1120 corporate tax status. So the way that it's similar to the 1065 partnership status is that it's a pass-through entity. So the S Corp would actually file its own tax return, which is a report. The S Corp does not pay taxes. That's a pass-through to your personal return, and that's where we deal with the taxes. That's how it is similar to the partnership tax return status. And then it's similar to the C Corp status in that owners are generally going to be paying themselves a salary for the work they do in the business. So, if you're set up just as a single member LLC, you're just taking owner draws. You're just taking distributions or draws out of the company as you make money and as you see fit. But once you elect that S Corp tax status, you're going to want to set yourself up as an employee on the payroll. And then you're basically splitting the income from your business as employee and then as dividends or distributions, and it's basically splitting that income so that you're taxed in 2 different ways. And so what is that tax? Why might I want to do that? Well, the biggest pro and the biggest reason is that whenever you pay yourself as an employee, that's active income. We have another podcast about active income if you want to check that out. We'll link it in the description below. But whenever you take a salary as an employee, or if you're just a single member LLC and you're just taking draws, all of that net income of your business is taxed at your ordinary tax rate, plus you have to pay the Social Security and Medicare, which is referred to as self-employment tax, on everything. So if you're a single member LLC, you're going to file a Schedule C on your tax return, and that's going to have your business revenues minus expenses, and then you're going to have a net income. And whatever that net income is, you're going to have to pay that 15.3% self-employment tax on that. And a lot of people, that catches them off guard. They may not be ready for that. It's significant. It's that FICA that if you were an employee somewhere is automatically getting withheld on your paychecks. And so that, if you're that single member LLC, if you have $60,000 of net income, well, you have to pay the 15.3% on all $60,000. If you had elected to be the S corporation, well, what you would do in that situation is you would have paid yourself a reasonable salary for the work that you've done. And that salary, so let's say the salary is $40,000. Well, you'd have to pay the 15.3% self-employment tax on that. However, the remaining $20,000, because that salary is a deduction for your business, so that now is only $20,000 of net income, and that $20,000 gets to essentially dodge the self-employment tax. And therefore, you're saving 15.3% on about $20,000 in that scenario. So we have a matrix that shows what salaries are acceptable by the IRS based on what your business net income is, because obviously the goal is to pay as little self-employment tax as possible. So you really want to pay your salary as small as, as small that is reasonable, so that you can have the most amount of the net income of your business avoiding that 15.3% tax. So that's a lot of information.
So Nick, I'll add to that the reasonable salary is determined by many factors. And so you want to pay yourself what you would pay somebody else to do the job that you're doing. And then the distributions that you take in addition to the salary also factor into that. So if you've taken $200,000 worth of distributions and you've paid yourself a $20,000 reasonable salary, that's not going to fly because you've had so many distributions. But if you had $20,000 in distributions and $20,000 in wages, then that may be considered reasonable.
Right. And so that is very important, because obviously you can't pay yourself, $5,000 salary and then take $100,000 in distributions and expect the IRS not to notice that. I mean, that's obviously a red flag. However, we do have a matrix that really helps show, where you should be with that salary. And if you have questions on that, please give us a call. Let us know. We're happy to help analyze that with you. But that S Corp status can be very beneficial from a tax perspective. And so a big question would be, which entities can elect the S status, the S Corp's tax status? So you would need to be an LLC. For example, a sole proprietor that has no LLC cannot elect the S Corp status. So you'd need to be the LLC. Or you can also be a corporation. So the corporate, like a C corporation, traditional corporation, as long as you have less than 100 shareholders, 100 or less shareholders. And there are a few other rules. And I know sometimes there's also a holding period if you've been a C Corp for a certain amount of years. We'll get that info linked below. So another important point I'd like to make is the S Corp makes the most sense for operational businesses. It wouldn't really make sense to set an S Corp up for a rental real estate business or an asset holding company, because you want your S Corp to be that in your operational business, and you really don't need multiple S Corps. It's good to have just one. Things can get kind of complicated if you have many S Corps, or if you have a lot of real estate in an S Corp, based on some of the rules. If you pass away, how does the stepped up basis and things like that play in? So we would recommend, if you're thinking about setting up an S Corp and you have many different businesses, come in for a consultation. We're happy to analyze, your situation, because everybody has a different specific situation.
And also I could add to that if you have a partnership and you want to elect an S status for your partnership, sometimes it's better for each of the individual partners to have their own S and leave the partnership a partnership, so that you can maybe you have uneven distributions, or maybe one partner has more deductions than another partner. You can do those unevenly within a partnership, but once you elect the S status, then we're not able to do that anymore. So if you have a partnership, there are 5 partners, we would not turn that partnership into an S. We would create an S for each of the individual partners.
Right. Yeah. Definitely want to think hard and do some analysis on that if you're in the partnership situation, because it can definitely inhibit some of the write-offs. So the big two reasons why would you convert? Obviously, we talked about one, to save on that self-employment tax. That's probably the biggest and most common reason why you'd want to. Another is actually that S corps are a lot less likely to be audited than Schedule Cs. In fact, research shows that they're about 15 times less likely to be audited than just a Schedule C on a 1040 tax return. So for those out there who are just single member LLCs, disregarded entities filing a tax return with that Schedule C on it, you're actually at a higher audit risk than someone who elects that S election and files the separate tax return would be. So that'd be another big benefit of why you might want to consider. Now, something I did want to mention is there's a certain point where we generally would recommend conversion, and that's usually going to be if your business, the net income is about $50,000 or greater. If you're below the 50,000, maybe 40 to 50,000, it might not make sense to convert at that time, because there are just some additional fees that are involved, such as running payroll. You do need to run payroll, file those payroll reports. And also there is a totally separate tax return that's going to need to be filed, and then some things like basis statements and just different things that need to be kept up with. And so you'll have to have an accountant involved with that. And so that might cost you, $2,000 to $3,000 a year, whereas the tax savings are going to be about, $2,000 to $3,000 a year until you get above, say, 40 to 50,000. And once you start getting above, that mark, that self-employment tax that you're saving is generally going to, be 2, 3, 4 times that as you continue to make more and more net income. So ultimately, it's a great idea, but it might not make sense if this is your very first year getting started. You might need to get a little bit of a foundation going first.
And Nick, how long do you have to make that election?
Yes, great question. So the S election, you're supposed to make that early in the year, by February 15th, I believe. However, the IRS has a rev proc that allows you to retroactively file a late S election. So if you're listening to this, it's towards the end of the year, and you're realizing, oh man, I should have made an S election, but I missed my deadline. I have $80,000 in net income. I'm going to have to pay more self-employment tax. Well, the good news is the IRS approves these late S elections because of that rev proc, and we can help with that. You can file it. It's a form that you send the IRS, and you just have to notate that it's a late election and you're requesting that relief. But they can retroactively grant you that status.
So Nick, if you have like a highly fluctuating business, like net income is going to be maybe 70, 80 one year, and then you project the next year is going to be 30, you can't just make the S election for the year that's going to be high income and then take it back the year that's going to be not high income and go back and forth. Isn't that right?
That's right. That's a good question. So, if you're thinking, oh, I'll be an S corp this year and then not the next year, it doesn't really work that way. You need to, once you become the S corp, you can revoke it, but it's a process, and it wouldn't make sense to flip flop. And so the IRS is gonna once you apply for that S election, you need to retain that in the future. So if you're in that situation where one year you're gonna have a lot of income and the next year you may not have as much, you really want to maybe look at the bigger picture and see if you're projecting your business to grow and grow, because generally if your business is going to grow, it would make a lot of sense. So how do I become an S corp on my tax status, and how do I file that 1120S tax return? So there are a few steps. The first step is you have to file the S election form. It's a form with the IRS. That's something that our office does, or you could ask your accountant, and I'm sure that they'd be able to help you with that. So you send in that form, and then number 2 is that you set up payroll. So if you're a single member LLC, for example, you'd set up a payroll system and put yourself on the payroll. And so you want to make sure that, you're not even necessarily having to move the money. That's one thing I'll mention, but you do need to file those payroll tax reports. So if you do that, for example, let's say you do that retroactive S election and you've already taken some distributions, but you want to kind of reclass that as payroll, that is something that you could do. You still need to file the payroll tax reports, pay in the payroll taxes. That's a bit, obviously important. But there's some reporting that we can do to help make that happen. If you're in one of those odds, one of those kind of tough situations at the end of the year. So that'd be the number 2, though, is you need to set up the payroll system. And then number 3 is, you need to file the 1120S tax return, which is going to be that flow-through tax report, which will have the information from your business. And so those are all things that our office helps with. If you're interested, please do let us know. Or if you already have an accountant, they should be able to help you with that. So last thing I'd like to talk about is, why would you not want to do an S Corp? Are there any cons? And really, the biggest cons are the extra fees involved in a payroll system and filing that additional tax return. Those are really your biggest cons. Mainly, I would say it makes sense to convert if you're at that 40 to 50,000 in net income, like I recommended.
In an operating business.
That is true. So if you're holding real estate, that would be a reason why you would not want to convert a business to an S Corp. And I don't know if I explained that earlier, but it has to do with basis in those fixed assets. And Mitzi, maybe you can expand just a little bit on that.
So there's a little bit of a difference, a large difference in whether you're holding assets in an entity taxed as an S Corp or say a partnership or a sole proprietorship. So if you want to transfer those assets, say the owner dies and his children are inheriting the assets, the S Corp status is treated as a corporation, which is not an individual, it's an entity. Where a partnership, you would be treated as an individual. So when you pass those assets to your heirs, they get a stepped up basis on the assets, which means they get fair market value as their basis. So if I have a $100,000 asset, I die, I transfer my asset to my heir, and the fair market value of that asset was $500,000. Now my heir's basis is the $500,000. Where if I was an S Corp and I transferred that same $100,000 asset to an heir, his basis is my basis. It's the basis of the corporation. So that's a huge difference. That's why we don't like to hold assets, appreciable assets, in an S Corp. Right.
Right. Yeah. All right. Well, that about wraps up this episode. Thank you so much for listening. If you're interested in S Corps, have any more questions, please leave a comment. We'd love to answer any of your questions. And thanks again for tuning in.